Hey, I tested the MACD indicator 100 times. Watch the full video to see the results. So if you're a beginner trader, I'm sure you've watched at least one trading guru that tells you about how great the MACD indicator is. All these guru does is tell you all about the strategies that you can implement in the MACD indicator. But have you ever watched like a full 30-minute trading video and walk out still not knowing crap? But because you just watched a long video, your brain kinda tricks you into thinking that you actually learned something and you thought you did something productive with those 30 minutes, but in reality you had no idea what the guy just said? Yeah, that's called sunk cost fallacy, and it's bad. But don't worry, we've all been there. So instead of bullcrapping about how great the MACD indicator is, I'm just gonna reveal to you the approximate win rate of the indicator, so you don't have to waste your precious time and money testing it yourself. Let me do all that for you. So first, there are two methods that I'm gonna be testing with the MACD indicator. So the first method is I'm gonna call it the normal method, which is just your normal way of using the MACD. The second is I'm gonna call it the new method. This method still uses the MACD indicator, but in a very different way. Some say that this second method actually gives a higher win rate. Let's see. So let me give a quick explanation just in case some of you don't know how the MACD works. There are four components in the MACD. This blue line is called the MACD line. This line moves faster and is more sensitive to price action, which will be the main focus of the MACD indicator. This orange line is called the signal line. This line reacts slower to price changes and is used to show the direction of a trend, less sensitive. It is mainly used to filter out market noises. Next, we have the MACD histogram. It simply represents the difference between the signal line and the MACD line. You can see that if the two lines are further apart, the histogram gets longer, and if the two lines are closer, the histogram gets shorter. Next, we have the baseline, which just shows the middle area of the MACD indicator. When the two lines are above the baseline, it indicates a bullish sentiment, meaning that the market is uptrending. And when it is below the baseline, it indicates a bearish momentum or a downtrend. So now that you know the parts of the MACD, I'm gonna explain to you how you use the MACD. Like I said in the start of the video, there are two methods that I'm gonna backtest. So the first method is called the normal method. This is simply how most people use the MACD indicator. So quick summary, there are two lines. It can be either above or below the baseline. If the two lines are below the baseline and the MACD line crosses above the signal line, you go long. And if the two lines are above the baseline and it crosses below the signal line, you go short. Pretty simple. Now for the new method. This is a different way of utilizing the MACD. The lines can be either above or below the baseline. If the lines are below the baseline, you wait for it to cross downwards again, then you take a short position. So after the lines crosses upwards, wait for it to cross downwards again while still being below the baseline. That's when you take your short position. It's the same example with the long position. When the lines are above the baseline and it crosses upwards again while still being above the baseline, you take a long position. For the normal method, it focuses on spotting reversals, as the lines are below the baseline when you go long. However, the new method focuses on trend continuations, as you enter a long position when the lines are already above the baseline. For my exit strategy, since we are solely testing the MACD indicator, that means I will also use the MACD indicator as my exit strategy. My exit strategy would be the same for those two methods. Every time the MACD line and the signal line crosses over, I exit my trade. It doesn't matter if it's above or below the baseline. If it crosses over at any point, I close the trade. There are a couple of rules that I use when backtesting an indicator. The first rule is measuring at a candle's close. What do I mean by this? Well, indicators collects data from the candle itself, so if the candle is still moving, the indicator would also be moving. That is why it is important to start measuring from a candle's close. For example, here we have a chart. Let's say I'm testing the normal method, so I'll start measuring here. Because it's a green candle, so the close is in the top part of the body, so I'll start here. And let's say, just an example, that our exit signal is here, and it happens to be a red candle. A red candle closes at the bottom of the candle's body, so the measurement would be from this point to this point. The next rule is that if my entry signal appears immediately after my exit signal, I'm gonna enter at the next candle. So what do I mean by this? Because our exit strategy is waiting for the MACD to cross over, there are often times where the MACD displays an entry signal right after it displays an exit signal, as shown here. So if this happens, I'll start measuring at the next candle's close. I'm gonna be using the EUR/USD 15-minute chart for this backtest. So here's an Excel sheet that I created to record this backtest. Here I can insert how much wins and loss I already got, and it would automatically calculate the win rate. So I'll consider a win if I make a profit. It does not matter how much pips I got. If I got a profit, I'll consider it a win. However, if I get a loss or a break even, I'm counting it as a loss. This backtest, I'm going to start with a capital of $10,000. And every trade, I'm using 150 times leverage. But I'm only trading with 1% of my capital per trade so that I would not blow up my account. This means that I would only risk 1% of my capital per trade. This Excel sheet also automatically counts your new capital after you trade. So for example, let's say I got 3 pips from a trade, so I'll enter it here, and it'll automatically calculate how much profit you got, what's your new capital, and what is your new trading budget, because like I said, I'll only risk 1% of my capital per trade. So this automatically calculates 1% from my new capital. Bear in mind that these results are just an approximate win rate because you can't determine the exact win rate of a strategy by only testing it 100 times. So, after backtesting these two types of MACD indicators 100 times, here are the results. So for the normal method, we have a 42% win rate with 42 wins and 58 losses. But even though the win rate is less than 50%, we still managed to come out profitable. We made a total of $10.13 or 9 pips from our $10,000 investment. Now remember that we didn't manage our losses and had a proper exit strategy. So if we had used a proper risk management and a good exit strategy, I'm pretty sure we would come out more profitable. We actually made $343 at some point. Our biggest single trade win was $115.42, which was about 57 pips. However, our biggest one trade loss was $156 or 77 pips. Like I said, had I used a correct exit plan and a proper risk management, I could have avoided that huge loss and exited that trade earlier. For the new MACD method, the second MACD strategy had a whopping 23% win rate, which is very far compared to the normal method with 42%. We lost a total of $93.75, which is about 46 pips using this indicator. At some point, we reached a profit of $138.33. Our biggest one trade profit was $59. And our biggest one trade loss was only $42. Unlike the normal method, where most losses come from huge one trade losses, this indicator's losses mostly comes from small yet continuous losses. So I think even though if we used a tight stop loss and the correct money management, the results wouldn't be any better either because the odds are simply against us. The concept of the new method kinda makes sense as it tries to capture continuation trends instead of reversals. Yet the normal method does a much better job of detecting continuation trends while giving a good entry. Because in my opinion, the new method tries so hard to capture continuation trends, meaning that the trend had already happened. It also displays a late signal and it's not even a good entry. Overall, I think the MACD does a really good job of spotting early trends. Of course, trends on the market does not always happen. Sometimes the market is stagnant, but the MACD rarely gives false signals for entry, especially when you combine it with a good exit indicator. If you want me to backtest multiple indicators, comment which indicators you want me to backtest below. And remember, the most important factor to determine your success is always money management, because trading is just a probability game, and finding which indicators has the highest probability would give you an edge. And if you pair that up with good money management, you will succeed at trading. And that's the end for me today. Subscribe if this content gave you value. Thank you so much for watching and I'll see you in the next video.